Thank you for joining us for our Seaspray Making Waves podcast series. Brought to you by Seaspray Financial Services Limited and Seaspray Private Limited. Seaspray Financial Services Limited and Seaspray Private Limited, trading as Seaspray Private, are regulated by the Central Bank of Ireland. This is Seaspray Making Waves podcast.
Hello again and welcome back to episode 8 of the Seaspray Making Waves podcast series. Just before we begin, a quick reminder that this podcast and the series is available now on Spotify, Apple and YouTube and directly from our website. You can also follow and like our content from our LinkedIn pages. And if I could take a moment just to direct you to our free weekly market review, which publishes every Monday morning from our website, along with our full suite of market updates and the video insights. We'd be delighted if you could have a look at that. So, with the housekeeping out of the way, just a quick update on what we're going to talk about today. We will take a look back in the rearview mirror at the quarter just gone, and then we look ahead at some investment opportunities and value for investors for the rest of 2024 and beyond. So to help me with the discussion and the analysis today, I'm delighted to be joined again by our regular Seaspray contributors, Paul McGowan, Managing Director of Seaspray Financial.
Good morning.
And Danny O'Leary, Head of Seaspray Private. Welcome back, guys.
Morning, Marty.
Great. Well, we have a lot to chew on from the first quarter, no doubt. So we'll crack into it. And Danny, if you could look at the global economy just for a second. Throughout our discussions in all of our podcasts this year, the focus has been on the 4 I's: inflation, interest rates, income, and investment growth. And we've already seen the rate cut cycles beginning in Europe and in the United States. But in your view, is there scope for cautious optimism for the global economy generally going forward?
Good question. I think the answer is yes. I do. I think there's always headwinds on the horizon, and geopolitical tensions are out there, and we can highlight those later on. But notwithstanding that, I think the focus in terms of where markets are on inflation, they're on interest rates, they're on the income and earnings, the fundamentals. And I think that will continue through to the end of the year. Just looking back, Marty, I think at the start of the year, we would have been optimistic that 2024 would be better than many would have anticipated. And I think as we're looking at the quarter 3 numbers, we're in the green. We have the NASDAQ up about 17%, S&P 16, 17%, Europe 7 or 8%, our own Isaac up 10%. So they're in the green right up until, the end of the third quarter. And that's a real positive because it hasn't been a straight line in any manner, shape or form. We've had an April downturn. We've had a May rally. We have an August downturn correction with the tech side. And we've had another one, recent one with the labor sort of market in the United States. So that's going to be a feature. Volatility will be a feature, I think, as we go through Q4 as well.
Yes.
And I bring in the geopolitical side, bringing that in as well. And not alone that, we also have an election, possibly a couple of elections that we're looking at home and abroad. But I think that the key that I'm looking at is that markets are looking through a lot of that. We've had a huge amount of elections already in the world in 2024. Markets have looked through that. So in the results that I'm looking at, I will come back to the 4 I's. So interest rates, you're absolutely right. We're now looking at interest rates in that downward cycle. We've had 2 cuts from the ECB, we've had the UK, and now we've had the Fed in terms of the interest rate cut. So the trajectory is in that downward sloping trajectory. Now, what the markets are doing is they're building in an awful lot of that already. So it's not just there now, it's where are we going with those interest rates over the next 6, 9, 12 months. I think the markets are pricing in at least 100 basis points in terms of US cuts.
Okay.
And likewise, I think Europe is more data dependent. Everything that the ECB are coming out with is that they will be cautious and look at that based on inflation numbers. But we are looking at inflation at near or at target levels, Marty. Yeah. I mean, at the start of the year, we knew it was going to be sticky, but it is coming down. And I think at inflation levels of 2.2, 2.5 in the States, and in Ireland 2%. I think they're at levels where the central banks can look at it on the basis that we have the firepower not to look at recessionary mode. We can actually maybe go where we believe a soft landing. Yeah. I hope that gives a sort of a balance.
Yeah, and there's a very interesting study in the last couple of weeks done where they looked at what is the optimum interest rates. And the authors of the study have come out and shown that the optimum level is 50 basis points above real rates. So in other words, if inflation is 2%, you're going to find interest rates will come down and rest about 2.5%.
Right. Yeah.
So that goes to the point that, in Europe, we're 3.5 to 3 3/4, depending on what measure you're taking. And the US is coming down. So we can see at least 1 to 1.5% cut from here in rates going forward, which, generally what that tends to do is you can sometimes get a little bit of nervousness in markets around that. But then people realize, actually, this is good for corporate earnings. So then you tend to find it becomes very supportive for markets. And I think, and this will be our house view, that by the time we get through the last quarter and into next year, as interest rates have come down, I think there's a really good case for a strong movement forward in markets again. Yeah. And corporate earnings have performed really strongly. The inflation, people didn't like it. Globally, we've seen a sort of a 20% hike in overall pricing since, let's say, from peak to trough. But now you're in a situation where corporates were also able to expand their profit margins. So there's been really strong profit margins, which has supported the price in the markets in terms of the price earnings. So into next year, with interest rates coming down, that'll help reduce the cost of interest for corporates, and that therefore will also benefit their bottom line. So overall,
and householders as well. I think if you're looking at tracker rates coming down, you're going to see that reduction, and it's helping in the pocket, because you're right. We've had 20% inflation. When you take over the last number of years, so cost of living is still very much evident. It's in the States, it's in here, it's in all of our economies. But I think the fact that it's now under control. We're not seeing it dramatically come down, but at the same time, we are seeing a measure where people are employed, incomes are reasonably, strong, corporate earnings are strong. It should support our house view that a soft landing from the Western economies is there. Yes. And we see that as optimistic for then 2025, 2026. I know I'm jumping ahead in terms of the years, but... Again, I keep coming back to it. We are sitting here every quarter and looking at all the turbulence and everything that goes on. 2 weeks ago, we were looking at a correction, or 3 weeks ago on the markets in the tech side. But they can produce opportunities as well. That's when, if you're looking at the long term, you can see the short-term volatility as giving you opportunity rather than the fear. And I think this is where I'm saying to everybody, markets will look through the volatility, and for clients, please sit through the volatility. Be patient, because that is where people will make the returns and not doing silly things in terms of volatility.
I'll return to that volatility question in a while, Danny, I will. And it's fair to say that there has been divergence between the two major economies in terms of their monetary policy, but there's a synchronicity returning. I think they're in tandem again. I think, aren't they?
I think at our last podcast we were highlighting that there was a sort of a movement away, but you're now seeing ECB, you're seeing rates moving in that direction. Actually, just at the beginning of August, we had the Bank of Japan going the other way. Right. They increased rates, and people were hearing what they call a yen carry trade.
Yes.
And people were saying, what are you talking about? This was because with deposit rates so low, investors, say in America, would have been buying up in yen and investing in Magnificent Seven or assets that were going to make them money. Now, when interest rates went up, that had a major impact on the currency. So they unwound those positions, and you had a situation whereby the market suddenly hit it 5, 6, 7%. So those things will happen, but nobody was anticipating a yen carry trade as part of that in terms of
and it was very interesting that the Bank of Japan actually realized that they were precipitating a collapse in markets. And so they moved to make statements at the time that, no, this is not, we're not going to push up, quickly. So investors were able to take relief and say, okay, I don't need to panic sell. I can unwind positions slowly over time. And then you saw markets through the end of August into September all rallied again. So what is interesting is that you mentioned coordinated. There definitely is the central banks work together, and they definitely are watching markets. Watching what they want is to keep a stability in financial systems across the world.
Definitely, and Paul, I know we've despite the economic upside that we touched on there, obviously the geopolitical risk, it's very much a real threat, and not least of all the conflicts in the Middle East, Europe, and obviously the looming US presidential election. But the question really is what has history taught us about events like that and the impact they have on markets?
Well, it's very interesting. In general, over the last 30 years, markets actually have gone up in periods of time when you have the major elections. So, we would still believe that the post-US election, either party gets in, markets will rally. There may be little shocks initially, but then markets rally after that. And, where we're standing at the moment, it's neck and neck. Nobody knows who's going to win in the US. At the end of the day, there is a lot of talk about policies, but when you look through their policies, many of the policies are quite similar. And it's all about really tax, So what we think is that the markets will rally in December because you're going to have further interest rate cuts in December. The Fed is definitely going to move again and will help that. And that will actually support the markets, as I was saying earlier.
I think Powell and the Fed are going to be the major factors rather than the election. We highlighted this at the start of the year. There were so many elections happening across the globe this year, and we're in the third quarter now.
Yeah.
Markets have come through that, and I believe that will be the same. And we may have one here in Ireland in the short term. It may be March, it may be November, but whatever it is, people are looking at the economy, they're looking at what's in their pocket, they're looking at all of those things. And I think if the trend is that we are now moving in a downward cycle of interest rates and inflation and cost of living issues are, being addressed, I think those are the key factors that you and I will be looking at in terms of where the next year is coming from.
It's important to mention it because it's an underlying factor that can't be ignored, for sure.
Now, saying all of this, the geopolitical, we're a year on from the October 7th and the Israeli-Hamas conflict. We're 3 years into Ukraine, and it's shocking.
Yeah.
Everything we're talking about here is on the financial side. The human side and everything like that, we keep saying this, it's shocking and it's terrible. But we have to look through that as well in terms of the longer term. And you are looking at trying to make sure that we can keep that moving in a direction where it's moving in the positive direction, but at the same time, make sure that if there can be peace and if there can be things happening in the world that can make sure that those are brought under control. But that's history.
Yeah.
We're never going to change that. That's going to be part of what we have to deal with going forward.
Exactly. For the purpose, our purpose is looking at the financial implications. Exactly. I know, and looking at the equities market generally, Danny. There was a focus that we mentioned on corporate earnings in the last quarter. And we did see that significant market correction early August, I think it was. So that brought us back a certain amount of volatility. But I think you mentioned that with volatility comes opportunity, right?
Yeah, I was surprised because we've mentioned the tech stocks as we did on the last podcast, and Nvidia has probably been the leading light in relation to that, and they came out with earnings which were absolutely substantial, over 30 billion. They beat expectations, and yet the market was nonplussed. They were saying, well, that's not good enough. And you're saying, wow. So even though it was excellent, they were hit.
Yeah. And the share price came back from about 125 down to 103, 104. Right. But then it started to rally again because the reality was they were phenomenal numbers. And so you saw the share price slowly coming back up into the 115s, 120s again. And that's supported long term by the demand. Now, there have been some interesting things that have come out that people are realizing that the development of AI is going to require huge amounts of data, huge amounts of power. And so there is a question over how green is AI. And, this is going to be something that's
Absolutely.
going to have to be looked at very carefully. And I think AI companies developers are going to be focusing in on building their own data centers and using alternative energy to drive the data centers to offset that power surge, which is going to be fascinating and opens up a whole load of areas for people to look at in terms of investment going forward, because this is going to be one of the big areas. So we have been looking at that internally, and we've kind of got a bank of stocks that we've been starting to follow, because we think there will be the next NVIDIA is going to come actually from maybe some of the support services to the AI companies.
Interesting.
Which will be really interesting.
Yeah.
And I think what you've seen in the last quarter is that the Magnificent Seven, as we call them, they have been totally in moving in the opposite direction to the broad market. I keep coming back to the fact that the rallies that we've seen over the last 18 months have been very tech-driven. I think we'll all agree. It's been in the tech sector. But we're now seeing, when I look at the earnings results from the S&P 500 and over 480 of those, you're seeing the broad market beating expectations by over 80% of those companies beat expectations. That's the earnings or the income side of the time. And it's a broader approach, which is what we would want, we would welcome, because that may maintain valuations at levels which are reasonable. And in Europe, likewise, if I take you back over the last 4 years, the S&P market is up about 70% over that time. European markets are only up about 30% in that 4-year period. So when we're looking at where we are now, valuations, in our opinion, are not stretched. Yes, the IT sector, but earnings from NVIDIA, et cetera, are supporting the levels of, and if you like, the expensiveness of those stocks. So we are still comfortable that there are opportunities. There are opportunities in key sectors, and we do believe that lower interest rates will support those valuations going forward.
Yes. Right. Okay, great. As we like to do in these podcasts, we're just going to turn the spotlight just onto the Irish economy for a second, Paul.
Yeah.
Obviously, our economic growth is continued at a pace, and there's embarrassment of riches, really, a corporation tax all-time highs, Apple court rulings, bumper windfall there.
I knew you'd bring in the 13 billion here,
And actually, it's going to be 14 and a bit. It looks like, because when you take the interest that they're being charged as well. So
yeah, I know. Well, in light of all that, you know, what are the sectors and companies that will benefit the most from that economic growth? And are there Irish stocks that we could maybe keep on a watch list?
Well, definitely. There are very interesting areas to look at. Recently, you may have seen the central bank came out with its latest report on housing.
Yeah.
And they suggested that we're going to have to build between 70 and 72,000 houses a year for the next 10 years in order to meet the demand in the economy. Now, in a country which you've already got full employment, that means we're going to have to bring in more workers. We're going to have to attract back more construction workers. So obviously, companies in the construction sector, the Cairn Homes of this world, those sort of companies will be beneficiaries.
Okay.
Now, if you take it that interest rates are going to be coming down, and we're going to be in a situation where we're going to be looking to try and build 70,000 houses a year, that's a big driver for the economy. Obviously, the Apple money, as it's called, the special money, some of it will be allocated towards construction. But money is not actually the problem in the country at the moment for construction. The problem has been finding the right locations and zoning. And, there seems to be too much zoning in the wrong areas and not enough in the areas where people want to be. So when we know within the next couple of months we're looking at a new government being called, when the new government gets in, the first thing they'll really need to do is address the planning laws, because this housing demand is becoming a major, major problem for us. So that's one area that's a benefit. Obviously, there's still strong growth in pharma, and we're seeing developments in those areas constantly now. And with a lot of the new technologies that were developed to help fight COVID, those new technologies are being applied to other pharmaceutical areas. And some of the companies that have their European headquarters in Ireland are focused on bringing some of those to a head. The other areas that will probably benefit, we're still seeing travel is a big element. Ryanair. If you look at the beginning of the year, we had recommended Ryanair as a buy. The stock ran up to over almost 20. Then it came off during the middle of the summer when it was suggested that there wasn't going to be as many people traveling. Very interestingly, the numbers then come out, the strongest travel numbers they've ever had. So the stock started to rally. We still think it's probably a buy at the current levels. There is a point that Mr. O'Leary is entitled to an extra 100 million of share options if he can have the share price above 21 for 28 straight days. That hasn't happened yet, but that's a definite target for him.
Yeah.
And, we like that stock and would still get back into it, and get clients to buy in at these levels.
Yeah.
So there's some of the benefits, because also with full employment and people earning standards, rising, particularly as interest rates come down, there'll be a bit more consumer spending. So travel is a big thing that people like. And so I would suggest we'll see a benefit there on that as well.
We're in a healthy place, I think.
I think on the money from Apple, I think we highlighted this earlier in the year. There are two long-term funds that the government now, in terms of climate and infrastructure, and the Strategic Investment Fund, which is part of the infrastructure scenario. My view here is that the government will be looking at parking a substantial amount to meet those goals over the next number of years.
Yeah.
It's not going to be used for day-to-day. This has got to be used in terms of aging population. It's got to be used in terms of the housing. It's got to be used in terms of the longer-term scenario. And I think you're going to see that as part of that plan in terms of part of those. But it does allow for the housing scenarios. Again, as Paul highlighted, I don't think it's all about money. This is about the planning. It's about the zoning. It's about a lot of other issues that are there in terms of that. But as it does give us a very strong positioning as we move out over the next number of years, definitely.
Brilliant, guys. It's great. I'm just going to bring it more internally and look at, thankfully, Danny, we've had a number of successful maturities with our structured solutions for clients this year. So you might, if you wouldn't mind, please just expanding on some of the investment themes that we backed in that time and what's in the pipeline.
No, absolutely. We've probably had about 14 maturities during the year, and that's showing where the markets have been in terms of the positivity in terms of year to date as well. So, and some of those maturities would have gone back over the last 3 years, Marty. So, it's not just the short term. So critically, we would have been in the climate change. We are absolutely, fundamentally as a business, we believe renewables, the transition from fossil fuels, it's a tsunami. The amount of money going in is massive. So if we look at 2023, when we had over 500 billion in the space of renewables, that to get us to the levels we need to be by 2030, that has to be at least 1.5 trillion per year.
Right.
There's a huge investment moving in the climate. And I think we'll all agree, we can see it in day to day that companies are using a lot more in terms of solar. They're using a lot more in terms of the renewable energy sources. So I think that is something that we'll be focusing on.
Okay.
Paul mentioned AI. We've firmly been in that, and we had a couple of maturities on both climate, AI, and technology. So we believe that if there are corrections in the market, we'll be looking at those as pricing to move in, because we believe that over the next number of years, they're going to be dominant themes for clients that we believe we can make, if you like, gains and have an investment opportunity for our clients as part of their overall portfolio.
Fantastic, Danny. That's great, and that's all good news. Now we're at that stage now where we take some client questions. So, Paul, I'm just going to come to you first. And your question is, although the Magnificent Seven tech stocks continue to dominate markets, are we starting to see a greater spread across markets to areas such as consumables, financials, and healthcare, for example? Yeah,
there's definitely, and we were talking about it earlier, there's definitely a spread moving out from it. But at the same time, the Magnificent Seven are there for a reason, because that's where the world is going. And so any portfolio, we wouldn't be suggesting switching out of them necessarily, rather deploying fresh capital into some of the other areas while still maintaining some of your holdings in the Magnificent Seven. Like, the Microsofts, the NVIDIAs, you really need to have those in your portfolios for the long term, or you're going to lose out on market performance. So having those, and then starting looking at some of the other areas, the consumables, some of the healthcare areas are good. Also the financials, there's been a good opportunity in financials, and when interest rates start to fall, the banks will start to see their profits grow further again. So, because their customers, you'll have less delinquencies, and you have a positive pickup. So I think the broader areas are worth looking at as well. So in Ireland, the Irish banks worth having a look at. As I said before, Ryanair, adding those in while still having your tech stocks in there.
Terrific. Great. That's a very clear response, Paul. Thanks. Danny, yours is on the deposits area. So I'll just read this side. Irish households currently have over 150 billion resting on deposit, with the vast majority of the money still in accounts that pay little or no interest. Which advice would you give if seeking a better return?
It's quite amazing, that statistic. We've gone through a lot over the last number of years, and the fact that, and I think the cautiousness, that's showing the cautiousness because of the uncertainty out there between pandemics, between cost of living and all the geopolitical. But again, I'll come back to it, that sitting doing nothing and having inflation at the levels that we've seen, that money is losing money. And my view is that people should be asking themselves, well, do I need it all sitting liquid? And the answer is, I don't think you need all of it sitting liquid. And that, I think, comes back to advice that you can actually be looking at short, medium, and maybe longer term scenarios. And when you do that, then you are looking at what we're talking about there, is that you can look at some of the companies, you can look at some of the structured solutions, you can look at building portfolios that have meaningful targets and objectives that pertain to your own risk profile, but that it's not all just sitting doing nothing. And if it's sitting doing nothing to the one, it is actually losing money. Believe it or not, people talk to me about risk. When you look at inflation and CPI, we've said 20% over the last number of years, sitting doing nothing is losing that purchasing power.
Yeah.
Whereas you could be managing that a lot better. So our advice would be, sit and talk, have a chat, and let's see what you really need liquid, and what could we look at as part of a portfolio. And I think that would be the advice I'd be giving it.
You won't believe it, but time has caught up with us again.
Can I mention one thing?
You can.
That bottle, there's over 500 million gone into the deposit return scheme since February.
My God.
I think that, and we mentioned this in February, the launch, and I mentioned my colleagues down in Cork University Hospital, the Porters and the 500 million. And I just think that is a huge achievement. People don't realize that everything that we're doing in terms of this now is taking litter off the streets, it's removing plastic, it's doing everything that we're right as a nation and as a community. Yeah. The milestone is there that it's over 500 million in a matter of months. So incredible. I just want to take this opportunity to say, keep doing it. And if you pass your bottles to me, I'll be taking them away afterwards.
Well, that's a very positive note to finish on, Danny. Thanks very much. So, Paul, Danny, excellent insight again today. Thanks very much. And we'll catch up with you next time.
Thanks, Paul. Thanks a million. Thanks.
So to read more detail on today's discussion, you can download for free now our Q3 investment review and outlook directly from our website, along with the full suite of market updates and video insights, which are also available for free subscription. Please, if you can, like and repost all of our content from our LinkedIn pages. And finally, just a reminder that this podcast and the series is available on Apple, Spotify, and YouTube. And you can subscribe for free to our dedicated Seaspray Making Waves YouTube channel. So that's it for today. And many thanks for watching. And we'll see you next time. Bye for now.
The preceding content is informational only and based on information available when created. It is not an offer or a solicitation nor is it tax or legal advice. It does not consider your financial circumstances and objectives and may not be suitable for you. Seaspray Private Limited, trading as Seaspray Private, is regulated by the Central Bank of Ireland. Seaspray Financial Services Limited, trading as Seaspray Mortgages, is regulated by the Central Bank of Ireland. Thank you.